Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So here's what I'm doing. I'm giving you a $199 off. So instead of the usual $3,999, it's only $3,800. So you'll have to call this number right here, 815-922-3329, and just mention ISE ETF webinar when you call, and we'll get you set up with $200 off. Let me keep this up here. Okay, so I've got a couple of questions here. There are options on the 2-time and 3-time ETFs. Are they liquid enough? You know, TJ, here's what I like to do with my students. Again, not just have your reliance on me and my answers, but teach you how to think for yourself. And I'll tell you what, a lot of people really get tripped up in how to measure liquidity. People say, well, oh yeah, you know, I have to look at the volume and the open interest and, you know, stand on my head and rub my stomach at the same time to find out what the, you know, the liquidity in this is. It's much simpler than that. It's much simpler. Here's what you do. Look at the width of the markets. Okay? If they're a couple pennies wide or, you know, maybe a nickel or so wide, they're liquid markets. If they're 20, 40 cents wide, they're not quite so liquid markets. Now, this is for a typical trader. I'm giving you this answer, you know, this answer. If you're typically trading 50 lots, 100 lots, 1,000 lots, that might not be enough. You might need to look at the size on the bid and the ask as well. But if you're a typical, you know, 5, 10, 20 lot trader, the market can absorb that usually. So just look for tight markets. That's really all you have to do. Now, by the way, you know, what is tight? I kind of gave the suggestion of a couple pennies or a nickel or something like that. But with very high value ETFs or stocks or indexes for that matter, you know, where the underlying is a very, very big nominal value, the markets will be wider as well. They necessarily have to be because they're based on a percentage of the underlying. So, I mean, it is all relative. But, you know, tight markets, good. Wide markets, bad. It's about that easy. Jeff wants to know about weekly options. Weekly options have become, you know, a lot more popular and a lot more liquid lately. Here's the thing about weekly options. Sometimes it can be tough to find a good trade. Like, people like weekly options because if they like selling premium, you know, you like selling options. You can sell them once a week and collect that high rate of time decay. But sometimes you look at it and it's just, you know, like the ones where you can get enough premium to make it worth selling are too close to the money. And, you know, the ones that are far enough that you want to sell, you know, you can get like a nickel or a dime for. So sometimes they're tough to find a good trade, but, hey, you know, I was just talking to one of my mentoring students today, and I said, hey, you know, for what you're doing, he was a diagonals trader. For what you're doing, always look at the weeklies first. John says, like penny increment stocks or options. Yeah, you're going back to the liquidity thing. Yeah, you know, options that are, you know, are traded a penny or two wide, these are nice liquid options, and you're fine. A typical trader ought to be able to trade within that and get in or out of anything he wants without moving the market. And John says, do ETF options work well with leaps? Sure. And again, kind of the whole point of this presentation is, if you've never traded ETF options, don't let them intimidate you. They're no different than stock options. If you're for me, like what I talk to a lot of students about as far as leaps go is diagonals. The student I was talking to today, we talked a little bit about long-term options. Buy the long-term in the money call, sell a short-term out of the money call. That's what's called a diagonal. You can do that on an individual stock. You can do that on an ETF. It's seamless. It's the same either way.
And Dan, what about rolling? I see a question about, you had a great example on the vertical. Would you recommend, let's say that the ETF did run up against that strike price sold, what do you tell your students about having a successful vertical spread and then possibly closing out the one leg and leaving your long so that you could be, take advantage of a further upside move? What kind of risk, what kind of rewards in that kind of trade?
Yeah. I actually was talking about a student earlier today as well about a very similar topic. The question that we had here today, which I answered one way, but Steve, you're bringing up an excellent point. I can kind of change that around and answer it a different way, given a different scenario.
Mm-hmm.
It's called adjustments, and the thing about adjustments are, they're for intermediate or advanced traders who really kind of get how options work and are limber enough to kind of, float like a butterfly and sting like a bee in and out of positions, And the market dictates what adjustment you make. You can't just learn one type of adjustment and say, oh yeah, I know how to do adjustments. Yeah, I just when I need to adjust, I just do this. No, it doesn't work. You let the market tell you what to do. So in that example of the bull call spread, okay, so if I own the 21 calls and I'm short the 22 calls, and the market rallies up to 22, in the scenario that I created to answer that question, I said, hey, I think it looks like this ETF is really going to shoot a whole bunch higher. Well, I'm just going to buy back those 22 calls. But what if I'm looking at it, I'm thinking, okay, well, I don't think we're going up to 24 or 25. I think I need a little bit more room to the upside. I think maybe, FCG can go up to 23, not 22. I was a little wrong the first time. Well, there's an adjustment that we call rolling up. And basically, while I have on this vertical spread, the 21-22 call spread, I can trade another vertical spread to roll. What I would do is I would put in an order with my broker to buy the 22-23 call spread. Now, what does that accomplish? Well, what that accomplishes is I close the 22 calls because I was short them and now I'm buying them, and I open up a new position being short the 23 calls. So now I still own the 21 calls, and now I'm only short the 23 calls. So basically, I gave myself a little bit more wiggle room. So that's what we call rolling up. And, there's rolling up, there's rolling down, there's rolling out, and, I'm actually, it's kind of funny we're talking about this. I do an online education series, which I'm not really promoting here, but if you go to my website, you can take a look at the online education that I do. And next month is all on adjustments. And the thing is the key to adjustments is let the market tell you what to do. And, you've got to be sharp, you've got to be nimble, and, you've got to understand a few important principles. But, man, you can be a really, really versatile trader if you understand how to do that stuff.
Good point. Very good point. Do you see John's question, Dan? I know this is a whole class, but the difference between a bull call and a bull put spread?
Sure. Well, I'll tell you, I can answer that question a gazillion different ways.
I know.
On the one hand, there's no difference. But that's a whole class for itself, I think, explaining why that answer is accurate. Basically, here's the difference, though, even though synthetically there is no difference. But basically, here's the difference. They're both bullish positions, okay? But one uses calls and one uses puts. Now, the difference is, with the bull call spread, I'm buying a lower strike and I'm selling a higher strike. Typically, what a lot of people do is they buy an at-the-money call and they sell an out-of-the-money call. And basically, we're just doing it like we did in this example where, we're kind of, for those of you who are familiar with covered calls, say, we're kind of using that long call as a proxy for the underlying stock and then writing a call to finance the call that we purchased. So we get a very, very inexpensive play with very, very limited downside risk with potentially a very high percentage exposure, possible profit. Here we could make, almost 100%. There's you make 90% in this example. Risk 35 cents and make 65 cents. Depending on how things work out, if the market goes right up to that short strike price, it's a great trade. The bull put spread, typically people sell a put that's out of the money and then buy a lower strike put that's further out of the money. And the idea there is, it's a little different. It's in the way that I'm describing how people typically do these, in both of these scenarios. The market doesn't have to move quite as much higher with that bull put spread that's out of the money. In fact, the market might not have to move any higher at all. It's more like a little bit of a line in the sand. It's not, if it's an out of the money bull put spread, it's not so much, hey, the market has to go higher. It just can't go lower beyond a certain point. So that's really the difference as far as how a typical trader trades them.
Good point. Hey, Dan, here's a question just for me. Why do you think ETFs have gotten so popular in the last couple of years, and especially now with options? What's the deal there? Obviously 10, 20 years ago, everyone was investing in mutual funds, and some people were buying stocks. And now you hear financial advisors talking about ETFs. They're putting their clients in. Why do you think that is?
They're just better for the consumer. I remember buying an ETF several years, or not an ETF, a mutual fund several years ago, and you pay a load of, a few percent. Here you can buy an ETF and just pay. Some online brokerage firms that are options friendly, you can pay under $1 per trade.
Right.
Or at least per contract. So it's they're just so less expensive, and they're just they're better for the consumer because they're less expensive and because you can get in and out whenever you want. Like if the market's tanking, like if you have a mutual fund, well, I'll get out at the end of the day after it's done tanking. An ETF, you can just say, boom, I'm out.
That's a good point. TJ has a question, and I know you know the answer to. Dan, I'm going to let you take it. What about trading options pre-market and aftermarket?
Yeah, well, unfortunately not. You can trade stocks pre-market and aftermarket, but unfortunately at this point not options.
And the good reason for that, Dan, is that bid-ask spreads would be way wide and people would complain about the fills they got. So we're all at the exchanges, the SEC, the brokers, we're all trying to protect the customers. And it's hard enough for market makers to create liquid markets through the trading day, but I think that maybe there'll be a day that we add some hours on the front end and the back end, but that some of us like to trade pre-market and aftermarket and equities, ETFs, but options will be coming. But you remember, and I think all of you guys know this, is that if you have a stop-loss order, that doesn't guarantee that whether it's an equity or an option, that you're going to get filled at your limit. And when you have gaps, bad things happening, you could get some really terrible prices. So I think we're all aware of that. Dan, do you see any other questions?
Yeah, there is one more that popped up. It says, can you make more money with a bull put spread because it's a credit? No, that's not necessarily so. I mean, it's all about risk-reward. And, sometimes you take in a credit of, 25 cents or 50 cents or whatever it is, you can only make the value of the credit. When I do a credit spread, which we didn't really talk about during this presentation, but when I sell a credit spread, the most I can make is the credit I received when I trade the spread, but I can probably lose more than that credit. So it's not necessarily true that you can make more with a bull put spread than a bull call spread, although, it depends on the strikes, it depends on the amount of time, it depends on the credit or debit, it depends on a lot of factors, but yeah, not necessarily true. All right.
Dan, you've given some of these presentations, and I have also. People believe that if they receive a credit, it's better than if they pay a debit because they're paying. And inferred in that credit is the fact that you're getting money now, and the debit, you're paying for it, and that is essentially the cost it carries. So Dan has pointed out, essentially, they're the same trades. You really need to understand debit versus credit. Correct, Dan?
Yeah, that's exactly it. All it really is a carry and a timing issue. It doesn't necessarily mean that one's better or you can make more with one or the other. It's a carry and a timing issue. That's it.
Well, Dan, I just want to thank you. I think that you took a subject that was very complex and made it, I believe, very easy to understand. Why use ETFs? Why options? Because of the unique payoff. You showed us a couple of payoff diagrams. You could have spent hours on those payoff diagrams, but essentially we didn't need the hours. We just needed one or two examples. You gave us that, and now we understand why some of us might want to use ETFs, why you might want to include options with ETFs. And I just want to remind everybody that if you go to markettaker.com, you could see all of Dan's offerings. And is that where your IC offer is, Dan?
Yeah. Just call the phone number that I gave.
Why don't you just take that back? Go back to that phone number. I see he's right there. 815-922-3329, correct?
Yeah, that's it. That's exactly right.
Well, Dan, I want to thank you for a great presentation. And anybody that's interested, please go to Dan's site. And again, thanks a lot, Dan. Really appreciate it.
Yeah, likewise, Steve. Thank you. Always glad to do these. These are a great benefit to to the people who enroll in them. So thank you as well.
You're welcome. That was Dan Passarelli from Market Taker Mentoring, MTM.
Yes.
And you can go. Let me just go back. Again, markettaker.com, or you can call the number if you're interested in Dan's services. Dan Passarelli also wrote a great book about the Greeks, so you can either buy that on its own or you could sign up for one of his mentoring services. I believe he mentioned that you'll receive that as part of the services.
Yep.
So thanks a lot, Dan.
Thanks, Steve. See ya.
Take care, Dan. I just want to remind everyone that next week we'll have, of course, more webinars coming. Mike Radke doing FX options trading and managing the underlying. And then the other Mike Tusaw, will be talking about considering diversification using ETFs and ETF options. So those will be the next two presentations. Getting a lot of great comments. I'm glad that you guys enjoy this presentation. We spent a lot of time. Dan spent a lot of time on that presentation. So I hope that you enjoyed it. He explained what an ETF is, why you use it, and thank you for the nice comments. I thought he did a great job, as I teach options very often. And it's not easy teach options, but we here at the ISC believe it's very important. So that's why I bring in the special guests such as Dan. Dan traded on the floor of the CBOE for many, many years, has taught a lot of classes on options, more than I can count on, on many, many hands as I have. And he's also written a great book. So Dan is very, very knowledgeable, and he's just one of our great panelists. So I want to thank all of you, the attendees, for making this presentation great, all your questions and your comments. We carefully consider all your comments, any suggestions you might have. Please come back for the mics next week. Mike Radke on FX and Mike Tusaw on ETFs next week at 3 o'clock Eastern Time and 4:30 Eastern Time. On behalf of the International Securities Exchange, it's Steve Meisinger wishing you a safe and happy trading day tomorrow. Don't forget, this is archived. In fact, all the presentations are archived, so you can go back to the ISC, www.isc.com/archives or /webinars, and you can listen to the presentation over and over and over again if that helps you with your trading. Thanks so much. On behalf of the ISC, Steve Meisinger wishing you a safe and happy trading day tomorrow. Bye all.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.